Porcelli with us, RBC Capital Markets. He has the fact of the day. I was in radio, Bloomberg surveillance, Sirius and XM, shameless plug time. Sirius and XM channel 113. Bring up the number right now. This is a killer number from a chief economist. This is why he gets the extra pay grade. Okay, bring it up here. The number, 2% nominal GDP, equivalent to $300 billion in corporate cash laying around. How much are the corporations harming our economy by building up this historic cash load?
I wouldn't say that they're harming our economy. Instead, what I would simply say is that they're being cautious. And it's, I think, the right move at this stage. We had another chart in that a piece that you were referencing, and it showed that confidence by CFOs remains just stunningly low. Yeah. And so they're doing the prudent thing. They are remaining cautious.
Why is their confidence so low? Alan Meltzer yesterday said it is this regulation worry. Yeah. The conservative crew will bring that up. Is that legit, or is there a different reason?
No, I think that's absolutely true. And I'll give you a sort of a small business example, which I think is very, very appropriate. I'm lucky enough to speak with some small business owners every once in a while. And they've all made pretty much a similar comment, which I think is fascinating. They've all said they are very worried about adding to headcount in an environment where there's still a lot of uncertainty with regard to regulation, with regard to healthcare. And I think that's keeping some, right, not all, but certainly keeping some on the sidelines.
And you saw it in the CBO budget today. Again, go to CBO and look for that 3-page summary of where we are with our budget from the best people that covered. Earlier this morning on Bloomberg Surveillance, I spoke with Jason Tyler of Ariel Investments Chicago. He's a White Sox fan. I asked him if he thinks the current economy is going to trigger a surge in M&A.
Yes. There's over $1 trillion in cash sitting on global corporate balance sheets right now. The last thing a CEO wants to do is shrink his company. It's better for senior management if they can grow the organization. And with rates as cheap as they are and with as much cash as sitting on the balance sheet, the best thing to do is to go out and find good acquisitions for the company. So I think we're going to see an awful lot of it, and that's part of the reason we own companies like Lazard.
Jason Tyler, an investment guy, you're an economics guy. Let's bring the two together. Schumpeterian creative destruction, another word around that in crisis is consolidation. Where is the consolidation?
I think what you have to remember, there are a couple of important things when we, again, thinking about cash on the balance sheet. I think there's a disconnect in a lot of analysis. And what we have to remember is, yes, cash is abundant, but the price on that cash is not necessarily as cheap as some people think. So as another sort of really great example, if you look at the small business survey from the NFIB, they actually have a series in there, and it says, it asks respondents, what are you paying for a loan right now, a short-term loan? And if you look at that loan versus the spread on prime, what you see is that it's still actually at a stunningly high rate. So not only are some companies actually paying up to get that credit, but the truth is there's still not a lot of demand for that credit right now. And that's one of the significant headwinds facing.
That demand, bring this up. I love this chart. This is the old ABC Comfort Index. Now it's the Bloomberg Consumer Comfort Index. Too much information. Way back, economists love this index, folks, because it's weekly. And it's just noodling along. Can public policy jumpstart nominal GDP, jumpstart animal spirits to get that confidence back?
No. How can they do that? I think, you know, we as Americans, we want things so quickly. Right? But I think the only thing that's really going to help this, and this is an answer that a lot of people don't like, is time. I think time is what is required to basically heal the mess that we just came out of. We're still going through a delevering process.
Yes.
And of course, Carmen Reinhart has done some fantastic work on this. It takes anywhere between 4 and 7 years for that to actually play through.
I don't disagree with that, but can't we do a surge a la what Krugman was talking about in his Keene speech? A surge just to clear the market and make it go faster?
Yeah, but at what cost? Right? You know, we're already dealing with a budget deficit that's $1.5 trillion right now. So I would not be a proponent of any additional government spending at this point. You know, one thing that we've continued to pound the table on, and most people are so focused on today, right? The headlines and how they're going to impact the markets today or tomorrow. But what I would say is, think about what's going to happen in 2018. Something very interesting happens. The population growth rates for those 65 and older starts to significantly outpace the population growth rates for those 20 to 64. That gap, which starts in 2018, lasts until 2044, and the average addition to the deficit over that period is about $1 trillion because of entitlements. So this is something that we have to face in the not too distant future. So I would not necessarily be a proponent of any additional spending. And again, moreover, what is that additional spending going to do for us? What sort of growth do you want? Because I would argue we exist in a 2.5% growth backdrop, and that's perfectly acceptable. I don't necessarily need to have 3.5 or 4% growth.
The growth rate's acceptable for at least. Look at this chart. Maybe we should buy new homes. I love this chart. It's got a regression. Let's have a moment of silence for that regression. Thank you to Tom Secunda and our people for inventing that regression. Look at that. New home sales, population adjusted. It's grim. There's the boom, and you can brilliantly see it. Look at the blue line, and we spike out 3 standard deviations of new home sales, population adjusted, and we come right back down. Can we get, okay, now bring it over, Victor. Stay with me, Victor, there. Can we get that line to come up just to get back to 1 standard deviation or to get the trend, which is the red line?
We're not expecting much from home sales this year. The fact is there's just not a lot of demand. At this point, the senior loan officer survey continues to play this out from the Fed.
Victor's damping in his eyes. He's got a little tears thing going there.
I'm sorry, Victor.
Look at that regression. I mean, we're going to do more of this, folks. I mean, it's great. We'll do kurtosis next week. No public policy on new home sales, right?
No. Not a proponent of that idea at all. Again, I think you have to remember, it's sort of interesting to me that we've had a lot of politicians suggest that banks need to lend more. Forced lending is effectively what got us into the mess to begin with, so I don't know why we'd want to go down that path again.
30 seconds. What do the Canadian banks get right? You work for RBC, the Royal Bank of Canada.
Yes.
Just generally, your observation, what do the Canadian banks do that we need to know best, that we need to learn?
I think, and again, I'm certainly not an expert on this.
Besides, give me tickets to the Montreal Canadiens. Shameless hint. Go.
We might be able to take care of you on that. I would say that, by nature, Canadian institutions tend to be a bit more conservative, so we were able to avoid a lot of the mistakes that some other banks made.
Right. Wonderful. Tom Porcelli, thank you so much.